All right, let's talk about investing. It can be pretty stressful, right? There's this one huge question that seems to trip everyone up. When is the absolute best time to buy? If you've ever found yourself frozen trying to guess which way the market's going to go next, you know exactly what I'm talking about. Today, we're going to look at a strategy that's all about taking that guesswork right out of the picture. So, first things first, we've got to talk about a feeling that's super common, this fear of making a huge mistake. I mean, it's a really powerful emotion, and it can stop a great financial plan dead in its tracks. I mean, just think about it for a second. You've done the hard work, you've saved up some money, you're all set to invest. And then that little voice of doubt starts whispering, what if I put my money in today and the market tanks tomorrow? Or what if I wait and I miss out on a huge rally? This hunt for the perfect moment, well, it can be completely paralyzing. And hey, if any of that sounds familiar, you are so not alone. Seriously, this fear of messing up keeps so many people just sitting on the sidelines, missing out on years of potential growth. But what if there was a different way? A strategy designed not just to manage risk, but to help us get over that very emotional hurdle. Okay, so let's shift gears from the problem to a really interesting solution. We're talking about a disciplined, steady hand strategy that takes the whole stressful game of market timing and just sets it aside. And here it is, dollar cost averaging, or DCA for short. The big idea here is actually incredibly simple. You just invest the exact same amount of money on a regular schedule. Maybe it's every month, maybe every week, and you do it no matter what the crazy market headlines are saying. It's all about consistency, not trying to be a psychic. So how does this actually look in practice? Let's walk through this super simple example. Imagine you decide to invest $500 every single month. Okay, so month one, the price is kind of high. Your $500 buys you a certain number of shares. But then in month two, whoa, the price drops. Now your same $500 actually buys you more shares. Then in month three, the price goes back up and you're back to buying fewer shares again. See what's happening? Over time, you automatically end up buying more when things are cheap and less when they're expensive. This smooths out your average cost per share without you even thinking about it. This whole consistency thing, well, it has some really powerful effects. So let's break down the clear-cut advantages you get from taking this kind of disciplined approach to building your wealth. You know, what's really cool about these benefits is how they all connect. When you reduce that timing risk, that fear of going all in right before a dip, you naturally take emotion out of the equation. You're not making decisions based on fear or greed anymore. Instead, you're building the habit, the discipline of regular investing, which is just crucial for long-term success. Plus, it makes investing so much more accessible, right? You don't need a giant lump sum. You can do it right from your paycheck. And when the markets get all shaky and volatile, that's when this strategy can really shine, letting you scoop up more assets when they're essentially on sale. But, like with any strategy, it's not a silver bullet. To get the full picture, we have to be honest and look at the other side of the coin. There are definitely some trade-offs to consider. I mean, it sounds pretty great, doesn't it? A less stressful, automated way to invest. So what's the catch? Where does this strategy maybe fall a little short? And here's the big one, the crucial trade-off. Over the long haul, historically, markets tend to trend upwards. It's a simple but powerful fact. And what that means is, on average, the sooner you can get your money fully invested, the better off you'll be. So investing a lump sum all at once has, on average, led to higher returns than spreading it out with DCA. Why? Well, it's because that cash you're holding back while you're dollar cost averaging is just sitting on the sidelines. It's not in the market working for you. That's the opportunity cost. And of course, it's really important to remember, if an asset you're buying is just in a permanent nosedive, no buying strategy is going to save it. Okay, so this brings us to what's probably the most important question of all. With all the pros and cons on the table, how do you figure out if dollar cost averaging is the right fit for you, your goals, and your personality? This table really boils it all down, doesn't it? It's the core trade-off right here. With DCA, you're basically saying, I'm willing to accept a potentially slightly lower return over the long run in exchange for way less risk of bad timing and a whole lot more emotional comfort. With a lump sum, you're taking on more risk and more stress for the chance at a higher average return. There's no single right or wrong answer here. It's all about which of these trade-offs you're more comfortable living with. So DCA really shines for certain people. For instance, if you're investing money from each paycheck, well, you're basically doing DCA by default. If you know that market swings make you nervous and anxious, this kind of hands-off, rules-based system can be a psychological lifesaver. And if you're just getting started with investing, it's a fantastic way to build those good habits without feeling totally overwhelmed. And really, this is what it all comes down to. This whole thing about dollar cost averaging, it isn't really about squeezing every last possible penny of profit out of the market. It's about managing your own behavior and managing your own risk. Think about it. The mathematically perfect strategy is completely worthless if a market downturn scares you so much that you sell everything at the absolute worst time. The best strategy is always the one you can actually stick with, through thick and thin, year after year. So, we'll leave you with this final question to think about. When you really know yourself as an investor, what's more important to you? Is it chasing the highest possible return, even if it means a bumpier, more stressful ride? Or is it about achieving a consistent, less stressful journey to building your wealth, one that lets you sleep well at night? Your answer to that question will tell you everything you need to know about the right strategy for you.